All right, so welcome to the fourth class, guys, of the course. As I mentioned, tonight is going to be over the market cycle and movement. I'm going to introduce you to the Elliott Wave Principle and Fibonacci. These two kind of go hand in hand in a sense, and you'll be able to understand that by the end of this class, actually, tonight. So, a little bit about Elliott Wave, guys. It's a very deep theory or principle. It's been around for a little bit, actually. But what I'm going to cover for you guys for this course is just the basics of it, okay? Because it's going to take you a minute to understand. But once you get the basics, we'll be able to expand upon that. The basics, though, will be just enough, or actually kind of more than enough, to really hone in on your trading and take it up a notch, right, basically. So let's get started. Boom. All right, market cycle and Elliott Wave. So Elliott Wave is it gives you guys the market movement, okay? The bulls versus the bears, or the buyers versus the sellers. We'll cover what is a retracement versus a trend reversal, all right? Because there's a difference, guys, okay? So we've seen the image to the right a few times by now. Where our previous class I drew, you know, a bull wave and a bearish wave, or bull move, or bullish trend, and things like that, right? So now we're going to get into a little bit of deeper study on those waves, though. Okay, so Elliott Wave basically teaches you basic wave patterns. It teaches you wave characteristics. It teaches you a few guidelines for application, and a few guidelines that help you look for or identify different parts of the whole cycle in the market. And there's 3 essential rules to Elliott, okay? And we'll cover all of this stuff, guys. And after this class, once you understand this, the basics of this, you'll be able to identify and label your waves, all right? But again, I want you guys to understand that this is a complex concept, all right? But we will just touch on the very basics to help you jumpstart your path. And remember, guys, all right, I'm going to repeat this a little bit. Cycles within cycles. And what that means is, if you look to the diagram to the right, if you notice the dark blue trend lines, or the dark blue line, that's one wave, right? How it's numbered 1, 2, 3, 4, 5 going up. The light blue line also has 5 waves within the first wave. That's what I mean by cycles within cycles. And I'll draw this for you a little bit later on. All right, so a little bit of history around Elliott Wave. The Elliott Wave Principle is based on Ralph Nelson Elliott's conviction that social or crowd behavior tends to trend and reverse in identifiable patterns or cycles. He identified a number of patterns or movement, or what we call waves, that reoccurred in combination with larger and or smaller versions of the same patterns. That's the beginning, guys, of the cycles within a cycle, all right? Those who are well versed in the intricacies of these patterns can gauge where the market's recent movements fit into them, and then predict where the market move will complete the cycle. Elliott cycles runs on every time frame, and because it runs on every time frame, that's what gives us the cycles within cycles. We focus mainly on the daily, 4-hour, and the 1-hour time frames to identify our Elliott waves, starting at the beginning of a swing low or a swing high. So those are our structure charts, right? And that's why we start on those charts, okay? Knowing the different characteristics of individual waves will help you identify which wave the market is currently trading within. But keep in mind, again, guys, cycles within cycles, okay? There's 3 essential rules for applying Elliott Wave and various guidelines that help apply and identify different components. Okay, so here's the basics, guys, all right? A single Elliott wave consists of 8 waves, okay? You've got 5 waves of impulse, okay? 5 waves of a bull or bearish trend, followed by 3 corrective waves. The 3 corrective waves are the retracement, all right? These waves are labeled using letters and numbers. So the impulse or the trend or the motive waves are labeled with the numbers 1, 2, 3, 4, 5. The retracements or the corrective waves are always labeled using letters A, B, C, D, E, F, G, and so forth. We'll get deeper into that on a deeper study. Each of the individual waves have their own characteristics that will help identify them. Again, guys, this cycle is found in both an uptrend and a downtrend. So the picture to the right, that's of an uptrend. If you flip it upside down, it would be a downtrend, basically. All right, here's the 3 cardinal rules, guys, okay? Take a picture of this, screenshot it, whatever you need to do, all right? Now, understand that these rules are merely guidelines that were proven to have a high success when followed, even though it's not 100%, okay? Understand, guys, there's nothing ever 100% in the Forex market. So the first cardinal rule says that wave 4 cannot enter the price territory of wave 1. If it does, the market's latest move must be part of a larger motive wave, which could be progressing higher or lower. All right. What I like to say is I would like to say, this is where I like to say if a retracement breaks the most recent low or high on a trend, you may be looking at a trend reversal, and we'll get into that later on, okay? The second rule, wave 2 can't retrace more than 100% of wave 1, according to the Market Technicians Association. If it does, then wave 2 might not be a corrective wave as originally thought and could actually be moving in the direction of a motive wave to a larger degree, a trend reversal. The rule number 3 says wave 3 can't, which often represents the strongest part of the market cycle, can't be the shortest by price when compared to either wave 1 or wave 5. Okay, so the picture to the right, starting at the very bottom with the light blue where it says wave 1, it says wave 2 never retraces more than 100% of wave 1. Okay, it can pin below the low of wave 1 to extend the low, but bodies of the candle should not close below that. It should always close below the low started at wave 1. The second one says wave 3 cannot be the shortest wave. Wave 3 is the green highlighted wave. That's usually your extended wave, guys, right, that I've been talking about. That wave usually consists of 5 waves in itself. The third rule says wave 4 does not have candles that close in the price territory of wave 1. Now, if wave 4 has candles that close in the territory of price of wave 1, or if wave 4 breaks the low of wave 2, then that's a trend reversal. So each of these waves, guys, whether it's a wave 1 through 5 or ABC, they have characteristics, all right? Every wave, impulse, and corrective have their own individual characteristics that help identify them. When applied together with the different guidelines that we'll cover later, identifying waves becomes just a little bit easier. One of the keys to interpreting wave counts is to determine what degree the wave impression represents. So let's talk about wave 1. Wave 1 is an impulse or a motive wave or a trend, right? Wave one is either at the top or the bottom of the trend, and it's kind of hard to identify as no clear change in trend is evident. So it'll look kind of choppy, all right? This is a less emotional as the prior trend is still in control, and that's why it's kind of hard to identify. Wave 2 is a retracement or a corrective wave, okay? Again, wave 2 cannot retrace more than 100% of wave 1, even though it can extend the low created by wave 1. Wave 2 is the first chance or the first time that you'll see or be able to use the guideline of alternation, and we'll cover this later. And in wave 2, traders usually continue to sell or buy So movements are usually steep and sharp. So what that statement means is traders usually continue the previous trend. So if in this example, it's we're in an uptrend, right? And wave two is the wave two as a complete cycle is looks like a downtrend in a sort of sense. But this is where I say it's only a retracement until it breaks the higher low, depending on what trend it's retracing against, right? Wave two usually corrects most of wave one. Wave three. Wave three is another trending wave or an impulse wave, and it's usually the largest change from swing low to swing high in terms of price. Powerful moves are made here in this wave actually, and that's what gives it its momentum and its volume, I guess. It's a emotional wave, most often the longest, steepest, and strongest of the wave, and it generates the greatest profit potential. Wave four is a corrective wave. You can apply guideline of alternation with wave two, right? And we'll go over that later. Early traders take profit, others enter long or short and witness whipsaws in wave four. Because wave four, more times than not, is like a consolidation. And wave five. Wave five is the final advance towards either the high or low, depending on the trend. Here we're looking for testing and failing at structure or support and resistance. And we're looking for a change in momentum. If using a RSD or MACD, we're looking for divergence, and we'll get deeper into that later as well. After this wave, the market will enter into a corrective phase. We like to say an ABC corrective phase, all right? But understand, looking at the picture to the right, okay, you all see the number 1 in parentheses above the 5, right? That is one impulse wave on a higher time frame. That's a cycle within a cycle, okay? So what I'm saying right now is that wave 1 through 5 is wave 1 on a higher time frame. All right. Corrective waves or retracements, their characteristics. Correction to the market happens after a trend or an impulse wave. Correction takes place after impulse waves 1, 3, and 5. The guideline of alternation can also be applied to the corrective waves, all right? The corrective waves are labeled with letters A, B, and C, but can be can be an extended correction, adding letters D, E, F, G, and so forth. So characteristics of correctional wave A or retracement wave A. The market will still be in an overall bullish or bearish trend, meaning this is only a correction to the market. Look to buy the dips on the bull market and look to sell on the uprising of the bearish market. If wave A travels in 5 waves, which is another cycle within cycle, it will be a deep zigzag, right? Or look like a lightning bolt. If wave A travels in 3 waves, it will be a flat or a triangle structure. So we like to call those like pennants, wedges, and stuff like that, right? Wave A also sets the tone for wave B in the corrective phase. Wave B. Wave B is the trap wave of the corrective phase, okay? Traders become euphoric and anxious to continue the prior trend because, again, this example was on a bull run, right? Wave B would be a bull run. It's a good place for a counter trend trade with wave C coming. As new traders, I wouldn't necessarily recommend you guys to try the counter trend trade, but wave C generates a lot of profit. All right. Wave C is the killer wave. It wipes out all positions from an impulse trend. All right. And it's often an extended wave. And that's why you can generate some profit with the counter trend on wave C. Once it's over, though, it's time to get back into the market and follow the main trend. All right. These are some of the retracement patterns. All right. So you've got like a failing wedge, bullish rectangle, bullish pennant, a rising wedge, bearish rectangle, bearish pennant. The bilateral patterns mean they can go either way. Okay. So you've got the ascending triangle or descending triangle, and then your symmetrical triangle. Now, depending on the complexity of the retracement, it will form different patterns and extend wave counts beyond the normal ABC. And we'll cover this in a deeper study, guys, after the full course, really. All right. Now, how do you apply this stuff, right? Or what are the guidelines for application? It's important to remember, guys, that a guideline, and when it comes to Forex, is not a hard and fast rule that can't be broken. It's a tendency, something that happens so often that it can almost qualify as a rule, except for the time that it doesn't work as expected. Okay, the guidelines are useful ways for applying Elliott wave analysis and have shown their validity over time. But as they are rules, they are not rules. They may not work out every time, so that's why they're more of guidelines. All right, so just a little warning. So I've mentioned market symmetry before. All right, and this is the reason why I've mentioned market symmetry. Okay, the market likes to stay balanced, guys. All right. So the guideline of equality means that two of the motive subwaves in a 5-wave sequence will tend toward equality, meaning that they'll be about the same length as far as price, right? And it's generally true of non-extended waves. So this means that when wave 3 of an impulse wave is the extended wave, wave 5 will approximately equal wave 1 in price. This is useful for potentially projecting the end of a wave 5 in an impulse if you recognize wave 3 as the extended wave. All right. It will also work if, let's say, this is a rare thing that happens, but if wave 1 is the extended wave, then wave 3 and 5 should be almost equal in trend size, right? The second guideline is the guideline of alternation for a trend or an impulse wave. All right. So the guideline of alternation right here is dealing with the retracement as a whole. All right. In relationship to the trend or the impulse. This is dealing with waves 2 and waves 4 as a whole. The guideline of alternation within an impulse says that the forms of wave 2 and wave 4 will alternate. So if wave 2, which is usually the sharp style of correction or the deep style of correction, wave 4 will be the sideways or the consolidation type of correction. All right. But if wave 2 is the sideways type of correction or the consolidation, then wave 4 will more than likely be the sharp or the steep or the deep one. This is useful for anticipating the end of a wave 4 correction within a suspected impulse. So if you see like a trend change, right? If you can see a clear trend change, all right, we want to see wave 1 happen, but we're not going to trade wave 1. All right, we're not going to enter until wave 2 happens. All right. And since we're able to, once you guys get down the guideline of alternation, you can see and understand what type of wave 2 may be. Okay, so more times than not, guys, it's the deep retracement, right? So that's going to retrace into like a 786, 886, 618 type of zone. Wave 4, which is this consolidation type of retracement, it may retrace as deep as 50%, but more times than not, it's above that, and that kicks off a heavy move or a strong move, wave 5, which will click or will almost equal the same price length of wave 1. And we'll cover all this on the charts eventually. The guideline of depth with corrective waves, guys. This helps you with understanding whether it's a trend reversal or just a retracement. Okay. When the market goes into a correction, it often will correct to the territory of the previous wave 4 of a lesser degree. All right. So this does not necessarily mean that it will reach the bottom of the previous 4th wave, but rather that we should expect it to reach the span of the previous wave 4 of a lesser degree. It's often a good place for the market to find support or resistance before the trend moves on. If the move extends beyond wave 4, look for the current move to be a change in trend. So the diagram to the right, guys, right? What that means is if the C wave of the ABC correction, right? If that breaks the low of wave 4, you're looking in a change of trend. Okay, so if that's the case, you want it to break the low of wave 4, come back and retest the high of wave 3 and the bottom of wave A and reject. That's going to signify a change of trend. All right, but according to that image to the right, if it starts to find support anywhere in between the zone of wave 3 and 4, then be looking to enter to continue the prior trend. Elliott Wave, the relation to Fibonacci, and this is that relation, guys. Gunnar, this is why we hold to those Fibonacci extensions. All right. Fibonacci ratio of the 618, it was made famous by the 13th century mathematician named Leonardo Fibonacci of Pisa. The sum of two based on a number sequence, adjacent numbers, forms the next higher number. I think I typed that wrong. The sum of the two, yeah, I typed that completely wrong. I butchered that. The sum of the two is based on the number sequence. Adjacent number forms the next higher number. So what that means is 1 plus 1 is going to equal 2. 1 plus 2 is going to equal 3. 2 plus 3 is going to equal 5, and so forth, right? It's the same thing with the Elliott wave, depending on the retracement. So if you add wave 3, right? If you're looking at the diagram to the right, it says wave 3 equals the 1.618 times wave 1. What that is if you look at the wave 1, that is a 100% move, right? And if you look at wave 2, hold on, thank you.
Sorry.
You're good. But so what we would do is fib from the bottom to the high of wave 1. That will be 100%. Wave 2 retraced to the 618 retracement. If you add the full move up plus the ratio that it retraced, you get the 1.618, which is the top of wave 3. That 1.618 is the negative 0.618 on my fib extensions. And that's why we wait, Gunnar, for the take profit to hit. So now you'll be understand, hey, just hold your trades because of, Elliott wave and Fibonacci. Now,
All right.
the 0.618, guys, is often referred to as the golden ratio or the divine ratio because it's been found throughout nature. It's in such as the breeding patterns of rabbits. It's found in the DNA double helix. It's found in how petals of a flower are arranged, portions of the human body, a galaxy spiral, and so on, right? So Fibonacci, guys, this is real life stuff, real life mathematics, real life numbers, right? The 5 waves of a motor phase have a Fibonacci relationship with the 8 waves of a complete cycle. And this is why there's cycles within cycles. Each wave or phase tends to have a Fibonacci relationship with other waves or phases. Thus, a retracement phase is often close to the 382, which is 1 minus the 618, or up to the 786, the length of the motor phase. All right. And we'll cover this in full detail with the Fibonacci retracements coming up. Are there any questions so far? Because I know that's a lot of information that I just went over.
I'm a little lost, but I think when you go into the Fibonacci retracement, I'll catch up.
Yeah, and
What he said.
No doubt. I'm gonna try to make it fit more together, guys, after we cover through this stuff. Okay. All right. So Fibonacci. Your goals right here is to learn the golden ratio, the different retracement levels, start to build your confluence, introduce you to ABCD, and understanding that Fibonacci goes with harmonics as well, but we're not going to get into harmonics in this course. That's some like deeper stuff. All right, again, Fibonacci, real life application and the golden ratio. Fibonacci, guys, again, constructs geometrical patterns such as your harmonics. And Fib is found throughout the world from life form to buildings. And if this diagram to the right showed you guys the relationship of the Fibonacci, it's used to find high probability trade setups on multiple time frames. The Fibonacci ratio, again, of the 618 was made famous by the famous mathematician Leonardo from Pisa, and is based on that number sequence. All right, so the Fibonacci and Elliott Wave relation, again, and this is, I'm going over this twice, guys, because again, it's important to understand. In Elliott Wave, the 5 waves of a motive phase have a Fibonacci relationship with the 8 waves of a complete cycle. So what that means is the five impulse waves, again, that creates one trend, okay? The ABC, the other 3 wave counts, that's the retracement. There's a relationship with that. So depending on where the retracement retraces to, whether it's the 382 or the 618, you can expect that move to a certain extension level, basically. And that's what this is saying, because it's a market symmetry. They like the market likes to move in symmetrical moves, basically. All right. The process of price discovery follows a similar fractal structure. The next price is always a function of the previous price in any market, even in the open. Again, this is all market symmetry. So when we're looking to enter the market, after you have determined what wave you are in, it's important to understand the retracement characteristics of the different Fib ratios. Knowing what kind of retracement the market is in will help you judge when may be a good possibility to enter or re-enter the market. The market retraces, again, at minimal to the 382 Fib and at the most to the 886 with little overshoot at times. If it shoots past that, you'll be looking at a trend reversal. If retracement retraces more than the 886, look for a trend to continue in that direction. So we're going to get into some retracement characteristics. Understand that there are 3 Fib retracement zones that we pay attention to, which is the 618, 786, and the 886, excuse me. Though the market can retrace, guys, to several different zones. Each of those zones have characteristics to help identify them. Pending orders work well in the area of the 786. And then using Fibonacci, guys, gives you extra confluence, and they're ideal ratios for harmonic patterns. So what though is actually the Fib telling you, right? What are the 0.618 and stuff like that, right? So the 38.2 means that was a 32% ratio. I mean, 38% retracement against the move. The diagram to the right, you start low. This is a bull run. You start low with the A, and then that's your swing low. And then you go to the swing high, which is B. We want to see that move happen, all right? And once we see B be created, or a swing high be created, we're going to pull out our fibs. Anytime you see 2 swing points on your most recent move, pull out your fibs, so that way you can measure how deep or how steep or how shallow wave C is going to come into, or point C is going to come in at, right? And then once you, depending on where it retraces to, again, guys, it's going to go up to at minimum the 1.618, which is my negative 0.618. All right. Price always pulls back to a level before a trend continuation, and that's why we want to see price retrace, reject, so that way we can react. And when price is retracing, guys, it's retracing to prior structure that was broken, or a void that was broken that hadn't been retested. All right. Now, the retracement characteristics, guys, okay? Depending on how deep or how shallow the retracement is going to determine how quick or how aggressive the move out of that retracement is. All right. So if the market retraces to the 38.2, then that's going to have a fast and aggressive move. If it's to the 50%, it's going to be a medium bounce speed. Again, the 618, the golden ratio. This is the first ratio that we're looking to enter or re-enter for a trend continuation trade. Pending orders start here or go halfway in between there and the 786 ratio. The 786, guys, is your pending order placement. And hold on just a second. Sorry about that, guys. Had an important call. All right. So, again, the negative 618 and the 270 are our extension levels and targets for trend continuation take profits. Okay. Down here says, remember to hide your stop loss within previous structure. I'll cover that later. But what I want you guys to take away from this picture is notice the difference in the bounce speed from the different retracement levels. So this will help you guys understand, not only will this help you guys understand what type of move to expect based off of retracement, Elliott Wave characteristics, right, will give you another perspective of what to look for based off the retracement. So for instance, let's say you're looking at wave 1. Wave 2 is a 618 retracement. Understand that in order for it to get to that next take profit, it's going to take some time because that's a slow bounce. The 786 is even a slower bounce, right? So wave 3 would be like an extended wave. Okay, it's going to move a lot of price, but it's going to be a gradual movement of price. Okay, now again, this is how you do it. ABCD. All right, now this ABCD has nothing to do with any type of Elliott Wave retracement or anything like that. Okay, the ABCD that we're looking at is talking about a swing low at your A and to swing B. That would be like wave 1. Okay. The point C is the end of wave 2 or the end of wave 4. Point D is going to be your take profit, which is the high or the low of the following wave. So AB is an impulse wave. At the image to the right, we'll say that's wave 1. BC is the retracement against the trend of wave 1. Okay, so BC, point C is going to be the end of wave 2. CD is the fib extension or another impulse wave. And that's why we hold it. All right. CD in this image, let's say that would be wave 3. Later on, we'll discover X ABCD as defined by harmonic patterns. And again, that's in the deeper study after the course. Once a fib level is reached, that becomes a price or PRZ, price reversal zone for entering. So what that says, what I'm saying right here, guys, is once you see wave C, or not wave C, once you see Fibonacci C, that's what I'm gonna deem that, Fibonacci C being completed, or it looks like it may be completed, understand that that's a price reversal zone. Previous class, I taught you guys, well, no, I haven't taught you guys. Well, previously, I taught you guys some candles, right, to be looking for at support and resistance. That's the zone that you want to hone in on, those candles. And we'll cover some things like that tonight, actually. So how do you apply Fibonacci on the charts? You begin by drawing from a significant low or high on a bullish trend, or a significant high to low on a bearish trend, right? From point A to B is an impulse of Elliott Wave. From B to C is the full retracement. From C to D is the continuation to the fib extension levels, which also is another impulse Elliott wave. So this system I'm teaching you guys, you're going to catch a full Elliott wave. Okay. Once ABCD is complete, you can redraw your fibs. Now, these reversal patterns that we're going to get into, guys, There are candle formations that indicate buyer sale opportunities at the fib retracement level C. Okay. Reversal patterns, guys, are patterns to look for at support resistance levels, and they form our entries. Reversal pattern is 1 to 3 candles. Sometimes it's more. To identify a potential reversal, we look for a quick, strong change in momentum in the opposite direction of the predominant trend. The stronger and quicker the reversal, the better. That signifies a lot of momentum and volume. To identify when price may be reversing, you're looking for a few different things on the candles. The first candle should create an initial higher low, with either its body or wick. Of course, that depends on the trend. The second candle should pin or extend the higher low, but close within the higher low of the first candle. The third candle should have a shift in momentum away from the higher low. Dojis and spinning tops are exceptions, and these reversals, guys, or these points, these are what create your swing points, your swing highs, your swing low. Okay. So here are some patterns that are highly reliable when you go to sell. Okay, so this would be the C point on a downtrend. All right. So they're called different things. I don't expect you guys to know every single one of these. What I do recommend is Googling some type of reversal pattern sheet or taking a picture of this and printing it out, hanging it above your trade station. So that way, when you see a potential move and you see an inside return or a retracement against that move, you see that move finding support or resistance at market structure, you're looking for these candle patterns to form. If you identify one of these candle patterns, guys, you're taking that trade. Some moderately reliable bearish patterns. Again, here you go. They got some names to them and stuff like that. But again, you don't have to know all of these. They're just good to see, I should say. Some bullish setups. Some moderately reliable bullish reversal patterns. Now, those are swing points, right? When you look at the market as a whole from a macro point of view, those swing points with other candles create technical charting patterns. All right. And then these patterns are telltale patterns that repeat. So let's cover some. So this would be like your M's and W's, your head and shoulders, your wedges, and stuff like that. Okay. Teacups, and you name it, basically. So there are various technical charting patterns that reoccur once they reach support and resistance. These patterns take time to show as they require many candles. So the higher the time frame, the more patience is required. Damn, I spelled that wrong, I think. There's head and shoulders. There's like your double tops or your that should be your M. I got that all the way backwards. So your double tops are actually M's. Your double bottoms are actually W's. Okay. You have to understand, guys, that there's different variations for each of these technical charting patterns, though. So what is a head and shoulder? Once completed, currency should continue in a bearish trend once the neckline is broke. There's a head and shoulders, which is shown to right, and then there's an inverted head and shoulders. The inverted head and shoulders would be for a bullish trend. This head and shoulders for a bearish trend. All right. It appears at the end of an uptrend, and it's 3 taps to the high. All should be formed by a bearish shift of momentum. All right. So what that means is look at the left shoulder, guys, right? Once it extended that high, all right, there was a shift in momentum back down or a retracement, right? Cool. Now, the middle portion is the head. That head basically extended that high and came right back down to the bottom of that retracement from the left shoulder, right? Cool. Also, that induces another change in momentum. The right shoulder tried to come up and reach the high that was created by the head. It never did. Okay. That was also followed by a change in momentum. Now, Once that shoulder got back to the neckline is the low that was created by the left shoulder. That's the neckline, okay? That's an area of indecision where we pay attention to, because price is either going to create a W right there with two double bottoms, or it's going to break that structure. If it breaks that structure, we're waiting for the pullback, guys, to that neckline to fail. And that's when we get in for our sell. And that would signify, again, a change in momentum or a change in trend. Double bottoms and double tops. These are your M's and W's, okay? I made another typo. Understand, guys, that double bottoms and double tops, they don't necessarily say that is the top or bottom of a trend. What am I trying to say? Okay, so let me just get through this and I'll explain it. So common chart patterns are double tops and double bottoms. They're very common, guys, all right? Double tops appear at the end of an uptrend. Double bottoms appear at the end of a downtrend. What we're looking for when it comes to double tops is the break in the neckline for a continuation. Again, M is the double top, W for the double bottom. The double bottom or the double top identifies resistance and structure. Double bottom identifies support, okay, and structure. In these, though, the second peak does not have to close at the same price. And if you take a trade like this, your TP more times than not is at the neckline if a continuation pattern isn't formed. So what I was going to say before I read all that is in double tops and double bottoms, guys, they can be found at the retracements. So for instance, if we're looking at the double top, right, that impulse leg up and the neckline down where it says stop, entry, and target, if it bounces off that neckline and uses that neckline as a support or a floor, that is still a double bottom, but that's going to continue the prior trend. But if it breaks that neckline and continues down, then that would be like a steeper retracement until it breaks the low of that impulse wave one, the very low, right? So here are some variations, guys, of the M and the W, okay? So the double top formations, you got I'm looking at the picture to the right top. The double top formations, you got the traditional, which looks like a perfect M. You've got the overbalance right down below that one. You've got the corrective, and that's what I was trying to describe prior to this slide, the corrective M. And then you've got the running M. All right, so those are different variations, guys. Down below that, you've got the double bottom formations, which is the exact opposite of the top. So if it's a corrective, guys, understand that these tops or bottoms have more potential to continue in line with the current trends, particularly if they are on the 50% or the 618 fib levels. So if you see this formation popping or bouncing off those levels, guys, right, that's what we're entering off of. The overbalance variation, this is where the correction prior to the double top or bottom is greater than the preceding correction and has more of a potential to reverse back up or down. This is where you can get into a trend reversal, okay? It can even spike, stop hunt with a pin bar above or below the supported resistance to give false moves before reversing. The running top or the running bottom, these will eventually reach a new higher low if there is reversal off the level back in line with the current trend, especially if the support and resistance level ties in with the 58 or 618 levels. And those are also second entries. Now, that's what I wanted to cover for tonight, guys, okay? So let me open up the floor for any type of questions right now. Go ahead.
All right. So on a live chart, when you look for these double tops and double bottoms, what happens when they form like the triple tops? Is that just an extra confluence that it's going to go in that direction?
Correct.
Okay, and what if after that it just starts consolidating? Are you reassessing, or are you just waiting for the move to happen?
So actually, let me draw this for you, and then I'll show you.
Do you also look for those in like? Do you look at in the candlestick form, or do you look at it in the you know how you do a line? You can do the candlestick, or you can do the
And you can do
like a
either
direct.
one. I would say look at it in a line form to have,
Mhm.
I guess, an easier look at it, and then once you see it, go to the candles.
Okay.
Yeah, we'll take a look on the live chart, but let me see this real quick.
Hey, Corey,
What's going on?
I'm gonna need you to release this video, man, because I gotta go back over this again. I'm just saying.
Hey, it's a
I'm
lot of
just saying.
nuggets in this, bro. A lot of nuggets in this one.
It's a
Yeah,
lot,
bro.
bro. I'm
Facts.
just trying
I
to
gotta go back over it too.
like.
Yeah,
There's a
yeah.
point where all I'm doing is basically taking screenshots. And I was taking notes. I was like, I'm taking notes. I'm like, I'm not listening to what you're saying, trying to
Right.
write down what the things are saying. So I'm taking screenshots. I'm trying to listen. So I just gotta,
Yeah.
yeah. Anyway,
Like
as
this.
you were, go ahead.
This is probably one of the most important classes, actually. This shit right here, because it's going to set the foundation for a lot of your price action, guys. Like I said, Elliott Wave it tells you the market cycle, and it ties in with Fibonacci because these retracements are going to dictate how big of the next move. So not only that, Elliott Waves tells you the characteristics of the moves, guys, right? So it's getting into like a lot of identification without any type of indicator, without any type of anything, guys. It's just basically going off price action, right? So this is why I said at the beginning of the course, if you just learn the basics of what I'm teaching you guys, this will tie into whatever system you guys learn, whether it's indicator or not, because what I'm teaching you is price action. So, and a
So
lot
is
of
Elliott Wave the?
go
Okay,
ahead.
sorry.
No, go ahead.
Is Elliott Wave like? Is that the most common move, like to look for into entering into a trade, or is it like the most common thing to like one of the first things, first confluences you look for to
I would
enter
say
a trade or?
I would say so. That and market structure. Because like I said, if you can identify Elliott Wave, it'll be easier for you to identify market structure and stuff like that that needs to be broken, or that where it should reject off of, and things of the sort.
Also, is it? I mean, you probably can do it, but like the beginning of an Elliott wave, probably don't know what's happening until it at least retest, right?
Right, and this is why we always look to enter at the retracements, right? Because
At
now
point two.
right, at either wave 2 or wave 4. Because now
Okay.
you've seen the prior trend, right? So you can kind of
Uh-huh.
judge, was the prior trend an extended wave? If so, look at the trend before that. Was it kind of smaller? Then you'll know what kind of wave you're in or about to enter. So for instance, we're at the end of wave 3, right? And we're entering into wave 4, which is a retracement. Now that we're in the retracement, I'm looking to see what type of retracement. Was wave 2 a deep retracement, or was it steep? If that's the case, I can understand what type of retracement, wave 4 is. Not only that, was wave 3 an extended wave, and was wave 1 kind of shorter, right? So now I can understand the move out of wave 4, what to look for and how long it should be, right? It's a whole lot of the stuff around this, guys, that is just basically price action and market psychology. So we'll get deeper into it though. But here's what I'm about to show you though, Gunnar. So let's say price did something like this. Okay.
Can't really see that yellow.
I'm gonna change the color for you then. Hold on.
Okay. Maybe I'm just blind.
You a little colorblind, bro.
I didn't think I was, but maybe I am now. Who knows?
Oh man. Let me change it real quick though. Boom. I'm gonna do free form. Boom. Draw. So let's say the market did something like this. All right. So we're looking at this right here. Right. So this was the downtrend, right? The previous momentum. This is the downtrend. This is, it's not perfect, but you know, structure. This is the structure over here that was broken, retested right here. And this would be the correction, right? This would be considered a double top. Now, I believe what you were asking though is after it taps the second time on the double top and begins consolidating, right? If you see this, guys, understand that it's consolidating off of this structure right here. Look for it to go up. Now, it's really going to tell you on the lower time frame right around that area. So if we're on the 1 hour and we're seeing, oh shoot, we're seeing this play out, right? At this area, if I'm at this area on the 1 hour, guys, I'm looking on the 15-minute chart to read my price action because it's going to present some type of candle pattern that's we're going to be able to identify. Does that help you out? I think Gunnar asked that question.
Yeah, that definitely helps me out.
That was Paul.
Oh, that was Paul. I'm sorry. Does that help you out, Paul?
Yeah, a little bit.
All right.
It's still a little like confusing, but
Well,
the more you go over
tell
it,
me
the more it makes
what's
sense.
confusing. What's confusing?
The whole entry point as far as analyzing on the 1 hour, then dropping down to the 15 and then knowing which price action candles to look for.
Ah, okay. So let me break that down then. So let's say, remember, I've got 3 charts, right? The 1 hour would be my structure. Structure. 15 is going to be my pattern setup, I should say. And it's not writing. Pattern setup. Okay. And so what I mean by that is, here's a few things would happen, right? So we're in this area of structure. And this is when cycles within cycles comes in handy, okay? So we see the tap right here, boom. We see this tap right here, but we see this break of structure. We go off most recent break of structure. Once I see this high is created, what is this, guys? This is a low. This is a higher low. Not only that, what is this, guys? Left shoulder, head, right shoulder. On a higher time frame, on let's say the daily or the 1 hour, that whole structure should be a swing point, okay, or some type of nice price action candle. Now, if that's the case, when we see this sideways motion, again, we're reading the same price action. It's above this structure. We have this a higher low than this low. So we should have fibbed from this low to this high. After we fibbed from this low to this high, this would probably, over here, this retracement right here was probably, oh man, come on. This retracement right here was probably a 382 retracement, okay? If that's the case, we already know that, hey, that next move should be pretty aggressive, continuing the prior trend. Not only that, this retracement, if it's a consolidation, let's say it might have been a wedge, it might have been a flag or a pennant. Now, we went over that a little bit earlier in the other classes. So now we're looking at technical charting patterns as a whole as well that also say, hey, it should go in your favor if you're looking on the buy side. Then, since this is all on the 1 hour, by the way, right? Once we're identifying all of this and prices at this structure point right here, we're going to the 15-minute chart to read the same type of candle pattern formations. Specifically, we want to see a break of structure with the break going in favor of a buy in this example. All right. So once we see that break of structure, we're again waiting for the retest to happen for our entry. We're going to fib from low to high, wherever that comes in at. And that break of structure should pin off in between the 618 and 886, which is met with this structure line right here somewhere. And so once we see that price approaching those fib levels, we're again looking for specific candle patterns or reversal patterns. So for instance, if I'm gonna go back to the PowerPoint presentation. If we're looking for a buy, right? Let me go back to and show you this real quick. What we're looking for is, let's say this retracement happened in this area, this box, that's our, this top line is our 618, this bottom line is our 886. If you see these candle patterns forming, guys, in that zone, that signals for you to buy. Not only that, if you see these candle patterns forming in that zone met with structure, now you're building a list of confluence that say buy, especially this engulfing. That's our most favorite type of trade to take, an engulfing met with structure that breaks some other structure on a lower time frame. So it's a whole thing that we're going to tie into once I get the system, I guess, taught to you guys, because now we're getting into the concepts. The next concepts after this would be the quarters theory and teaching you guys the MACD and the moving average. Outside of that, guys, after that, it's just basically going through the whole system as a whole, step by step. So starting from A to B, you know, how do you apply the concepts and when? And that's going to give you the whole system, and that's going to be the rest of the course. But does that kind of break it down for you now, though?
Yeah, it's definitely making a lot of sense.
Bad. That's what I needed to know. So
yeah. It definitely is, because like the minute you know the structure of it, no matter what, it's going to repeat. You got to know what trend, if it's going up or down. It's just really, I'm sorry to cut you off.
No, you're straight. I mean, that's really all it is, guys. I mean, like
it's just like remembering, I guess. I mean, can I ask you a question? I guess for your candles, like what candlesticks do you potentially like to look at more? Because since there's so many like patterns, is it more about like what candlestick patterns you see more clearly? You've been like, okay, I see this the clearest day. I'm gonna use this, or do you try to like know a little bit of everything?
So no, starting out, that's a great question, actually. So starting out, guys, like I said, there's a lot of candle patterns out there, but I'm not focused on every single one. Starting out, I'm focused on the engulfing. That's it, this engulfing pattern. So if after a retracement, at the end of a retracement in my PRZ zone or price reversal zone for my entries, if I see this engulfing on, let's say, my structure chart, or even my second chart, which is my setup chart, I'm looking to, in my favor, I'm going to enter, basically, because more times than not, guys, this is a highly favorable pattern, and that's why I take the engulfing. Outside of that, I've added like a couple of more, but starting out, guys, just focus on the engulfing, because that's going to be the highest probability of the trade going into your favor, and that's what this is all about: building up your confidence at first.
Say, Wallis,
What's going on?
so how often do you really like say like triple bottoms or triple tops or whatever?
Well, let's take a look. Let's look at some charts real quick.
Cause like you said, you see him when it's consolidating right there. You know what I'm saying? How I did like a double top, double bottom, then consolidated. You know what I'm saying? So like, I don't know. I probably would have put a sell on it. I don't know. I get confused right there when consolidated.
That's a good question. So let me bring up this pair.
How the market slow up. You know how the market slow up and consolidate and go sideways for a while. Then I don't know where to go. You know what I'm saying?
So this right here, this pattern right here has been giving people fits all week.
DJ is good for it.
Yes, it is good for it. So this actually it kind of it this is a good example because I can give you guys price action now on a deeper level, right? So let me draw this box.
So that would that be considered a flag pattern, or
What'd you say?
would that be considered a flag pattern that you're waiting for the breakout?
Yeah, I'm gonna get into that. I'll get into that. So what I want to pay attention to is this right here. I'm gonna zoom in on this because this is when understanding, you know, higher highs and higher lows and stuff like that, and being like really precise as far as understanding that, yo, price is tricky. Like it's tricky, guys. So we've got this bearish move right here that broke this structure, right? And then we've got all of this right here that is kind of like a inside return. You see this previous trend right here, which was kind of a steep retracement against the prior trend a little bit, right? Let me pull out the fibs. Let's say we go from this high to this low. So this is, it looks more of like a steeper retracement, even though it retraced to the 382, right? Cool. Now let's look at this retracement. It's a long consolidation, guys, right? So not only that, it kept rejecting off the 382. So we expected a move off to continue, right? Which it did. Now, here's what I want you guys to pay attention to as far as price action, man. When it comes to understanding a higher high, higher low, or a lower high, lower low, guys, pay attention to that stuff, because this right here. Come on now, where's my drawing tool? All right. So we've
Hey,
got,
Bossman, can I ask you a question?
yes, sir.
The two lines that are like up there, like the two ones up above, are
Right here.
they? Did you put those in the weekly or the day? Because I know we're on the 4 hour chart. I was just curious about where'd you set those two at.
These are actually what were set on the 1 hour chart.
Okay, so you're ceiling up there and your floor right here on the hourly. So and that's just okay.
Right.
Okay, that was just a random question I was asking.
Oh, you're cool.
All right, thank you, man.
No doubt. All right. So what I'm circling, guys, is indeed higher highs. I mean, lower highs. Am I not? Now,
Are those just the closing points, not the wicks, right?
so no, I'm using the wick to signify this first wick right here set the high, initial high in this whole range, right? These wicks over here. Now, as I look over here, yeah, the wicks may come over here, but after I see this high, I'm looking for the closes. Where are they closing in relationship to the high? As I keep going down, right, what's happening? It's making lower highs. The blows, though, aren't really going anywhere. So if we look at that, that would be more of a wedge type of thing, right? If I drew the trend line. Oh shit, that's not it. If I drew my trend line, right? That's more of a wedge. Um, but I wanted to point that out because that was a good question that Torrance asked as far as like the triple bottoms, right? You would expect that to go up. And this, if you're just looking at it, this is all you're seeing right here. You know, bottom hit, bottom hit, bottom hit. And every time it hit the bottom, it made some nice reversal patterns though, right? Did it not? But you have to pay attention to the price action of the candles. And this is where if you have any kind of indicators, you can get into some type of trouble because I kid you not, on the MACD, it was saying buy. It was giving you the buy, right? Saying go long. But price was giving you lower lows, I mean, a lower high every time. This is a form of divergence, something that we'll go over later once I introduce the MACD to you.
Right, so you gotta pay attention to the price action because my indicators gonna lag on you.
Exactly, and that's why I'm trying to teach you guys price action over anything. So it did break down, but now that it's back entered into that level, what I'm looking for is I'm waiting for this move to happen. It should stall out somewhere up here. I'm looking for the inside return from this low into wherever it stalls out, guys. I'm gonna pull out my fib. And if it comes down and rejects off of this line right here, that's my entry zone for the buy to go long. Hopefully the classes tonight help that make a little bit more sense to you guys.
So,
So your A
question.
would be that first bullish candle.
Yeah, A will be down here. The high that it creates would be B. C should be some type of rejection met with structure, maybe right around here. And then we'll ride it up to D, which will probably be up here somewhere. So let's say, let's just try to visualize this real quick, right? Boom. So let's say it does something like this. Let's say this push right here completes up there, right? If that's if it completes right here and I see this first push A on the correction A, I'm pulling out my fibs automatically. Boom. All right. Because what should happen is it's going to retest that high and fail. This is where people get got. All right. This is why it's crucial to understand Elliott Wave, because once you see A complete and you buy right here, it's going to test that high and more times than not reject. Okay. And then kill your account, hit your stop loss. Boom. That's what the market does. Now that this C is completed in our entry zone met with this structure over here, we can enter and write it up more all the time to the 618 is what I typically do. But coincidentally, what is the 618 met with? This structure over here. Hold on, let me delineate it for you. This structure over here, damn near, right? So what happens is once you see this top right here, this is going to be the next top as far as understanding a double top or a M formation, because again, here's the main trends. We're just catching the smaller pieces of it, right? Is it starting to make a little bit sense to you now? This would be like a corrective M if it rejects off of this high right here and goes down. Or it's going to be a continuation if it does that, comes up here, consolidates, right, and goes up. Because then that
Is that
consolidates. Go ahead.
I'm sorry. Is that ABC? Is that after the Elliott wave? Is that what that is?
That's yes. That's after the impulse or the trend wave.
Okay. I'm just having trouble with trying to figure out when. So that's a double top at the bottom. Those two long bars at the bottom. That's a double top, and then yeah.
No, that's not a double top or anything like that. This isn't a double bottom or anything. This is just a candle pattern.
Okay.
So the double.
That's the beginning.
Those train tracks.
Right.
Train tracks. Oh man. All right.
It's a lot, guys. It's a lot, but
It is.
as we go deeper into it, guys, things are going to start to click and stick together. That's why I want to spend some time with you all, because like I said, the concepts like that I'm teaching guys it's nothing new. A lot of trade systems are surrounded or built upon the same concepts. So,
Got you. Question real quick.
go ahead.
So you see where you have your four circles at?
Yeah.
Okay, so you were measuring from like your highest high was the wicks.
Yeah.
So is it okay to draw your ceiling from those two wicks all the way across?
It is.
Touching the candlesticks, or because like I was wondering, like, do you just consistently have to have the wicks connect with the wicks, or can the top two wicks you pick as your highest high connect to the candlestick bodies? Because the candlesticks reject that ceiling, that means you're going on a reversal trend.
So if I'm understanding you, so if you see this box right here, I drew it at the top of these wicks, right? And I drew the low at the lower of the wicks. So if these candles right here, if they came up here and closed right here, and their wicks crossed above that, that's perfectly fine because we're going off the initial high.
Okay, so it's the initial high of the wicks and initial low of the wicks. That is your ceiling and your floor.
Correct.
You're looking for your candlestick to hit those wicks, and the wicks go above those.
Correct.
That's okay. Just making sure. All right, because I was thinking like I heard. Okay, that makes more sense.
Yeah. So I mean, and then it's like once you find your initial high and low, whether it's in consolidation or at the end of a trend, like the next higher lows that are set, like they can honestly, like as long as those candles, the bodies of the candles are closed below those wicks, then you're still in a valid setup or a valid trade. Now, once price gets up above it and closes though, if the next couple of candles don't immediately slam back into the area, for instance, like this right here, then that, that's like a reversal. So this
okay, see, that makes more sense. Okay, because I was just trying to make sure. So now the candlesticks, if the first initial candlesticks broke above the ceiling, it pretty much went through structure. So now you have to find the new structure. Okay.
Exactly. So now you got this right here would be some structure, but this is still some powerful structure. So now this is exactly what I was talking about, how this slammed through the bottom, but immediately came right back into that same zone, right?
Yeah, and that was pretty much like a bearish trap right there.
Exactly. Maybe so let's look at this though, from like a broker stand of view. if you're looking at this and we're thinking about going long, guys, what is below all this right here? People stop losses, right? Not only that, you've got sell stops. So all of that right there builds that liquidity pool, extra money to make a move happen that the broker went after right here, took your ass out, collected your money, made you sad, and now it's back up in the zone. So we're still careful as far as is this going to continue and break this high right here? And if so, we're going to look for that retest once it does the inside return for our entry to go long.
All right. So on that note, with them building this liquidity pool and doing stop hunts, where is a safe place to put your stop loss if you were to kind of just set it and let it play out?
I use my fib levels, right? And my stop loss is usually right here at the 1.1 set with prior structure. So if, like I said, if you're looking at this, understand, guys, that there's no real way or no real structure that we can go off over here that says put my stop loss here. This is recent structure. You never want to put your stop loss with recent structure. So you would honestly have to zoom out and find this low right here. This low right here. But even if you set it at that low, guess what? You got taken out, right? So again, like I said, guys, you're never going to be 100% in the Forex system or in the Forex industry. And this is the reason why, because they do crazy shit like this. They hit your stop loss. Like this is proper stop loss placement right over here. They still hit it. And even though they still hit it, they barely hit that mug, right? And then it came right back into your zone. So now we're still looking for the buy.
So when it's in consolidation like that, do you just kind of wait for it to play out and make a proper structure before you start buying or selling? Before you can make your decision?
Correct. That's what's heavily recommended. Not only that, if you want to trade a consolidation, understand that, your best chance for entries are going to be at the lows and the highs of it. So if you entered over here, yeah, I mean, that's a good solid trade. Like, I can't lie. Like, if that's all you're seeing it as a beginner, hey, that's still a nice trade to take. But, you just got taken out by the broker.
So trading in a consolidation is basically like you're just doing a sniping. You're just trying to get in
Scalp
and get out real quick.
and get out. Understand, once market reaches the support or resistance, depending on what trade you took, get out, bro. Then once market breaks one way or the other, that's when you look for the retrace right back into this for your entry. So for instance, in this consolidation, I want to see this honestly, since it came right back into it, I want to see it come up to this high and then retrace, test some type of structure, and then get in.
How would you know when it's going to do that? Though? I mean, if that at the top of that box
Right.
is your resistance,
Yeah.
then how would you look at all those different? There's like 4 different times. How would you know which time is the right time for it to be? You know what I'm saying? And it retests back, and then how would you know? Because to me, it looked like it hit basically the top of the resistance, came back down, and then it just did it over again. How would you know which time is going to be the time for it to break out?
Because you'll see a consolidation in this area, or more than likely another consolidation in this area, which since again this is newer structure, this is the low now, right? If
Yeah.
it makes a lower high, I mean a higher low, that's what you're looking for. So let's say we feel from this low and let's say it rejects off of this high over here, off this wick somewhere, right? And it starts to retrace, or even if it retraces to our 786 and starts to reject, it doesn't even matter at this point. We're looking for it to reject. It's making a higher low than right here. So we're going to go long. So not only that, we have to be mindful of our 3 charts. What's our structure? What's our entry setup? And what's our candlestick entry charts, right? So let's break this down real quick. Since we're looking at this on the 4-hour, let me get my stuff right. I'm going to put this at the bodies. So first thing I want to do is notate the most recent breakup structure, right? I touched on what is a breakup structure, I think in a previous class, just briefly. I see the most recent breakup structure, this bottom line structure, this bottom purple line is 4-hour structure. This is a breakup structure. First candle to break it. Here's the second. Now what I want to see is a retest to the top of this structure that possibly fails, right? Let's see if I can delineate that or see that on a 30-minute time frame. So this will be the candle entry time frame, right? So immediately I'm seeing a shoulder, head, and a shoulder. Now, this is a higher low than this. This is indeed a higher low than this. This is another retest to this low that's higher than this. This is an engulfing candle with no wick towards the bottom, which means there's no sellers present in this candle at all, guys. So the retest of this structure could have already happened, but from this low to wherever this high is created, I still want to see a strong kind of retest, if that kind of makes sense, to induce people to go back short following this trend off of this structure. But if it doesn't happen, that's okay. That's just what I'm expecting. So until I see this candle close and see what the next 30-minute candle does. So at 9 o'clock is going to be a new 4-hour candle, right? I'm expecting this next 9 o'clock 4-hour candle to be bearish. That's me personally. Now, it may not be bearish, but that's what I want or what I need to see in order to validate this as a buy. I need to see a bearish move on my structure chart that fails. Okay. Once I see that, now I'm on my 30-minute chart because it correlates with the 4-hour. Now I'm on my 30-minute chart looking for the candle reversal patterns to form at the structure that is failing on the 4-hour. Okay. Once I see a potential, let's say I feel from low to high right here, right? Once I see this inside return, if it's failing, at these fib levels, it's creating a higher low than right here. So let's say it starts to act up over here. I'm pulling up my candle reversal pattern sheet if I need to, right? Or I'm looking at the technical charting patterns if it forms a longer consolidation or a longer reversal pattern. And I'm looking for that to form at the structure, some type of structure on the lower time frame. That would be somewhere around here. This is a clean or a perfect breakup structure. Okay, these three candles right here. So on the 15 or the 5-minute chart, I'm gonna highlight the structure right here that it probably broke. But if I see that, the market came up and retested right here, cool. That's my entry. Like I said, I want to see an engulfing candle like this that I want to take. So let's look right here real quick. So y'all see this right here? This is the high right here. This is the initial high, that this wick right here, right? This candle broke that high, closed up above it. This is the retest to that high. This is the third candle. That's what I mean by a clean break of structure. Okay, so this structure though, this would be what C's and them call what? Your void, right? So it only makes sense now for price to come back down here, return, test that void, make a lower high than this. I mean, a higher low than this low, and then continue back up. Does that bring it into full circle for you a little bit?
That actually makes something click on the voids.
Bet.
Yeah, that's good.
Because then it would come right down to the 618 or the
Right. Exactly. Now y'all see how the fibs are tying in.
yes.
Yeah. Exactly, guys. Exactly. But like I said, guys, what I'm teaching you is just basically price action, guys. Like it's nothing special. Well, I'm not gonna say it's nothing special, but it's nothing new. It's nothing new, basically. Like this is time and time proven. You know what I'm saying? But I just have my own spin on it. Like I add a few different concepts or whatever, and go from there with it.
How we know we ain't gonna come all the way down to that 618 instead of just that 382 spot? That's why I get kind of confused there too.
You never really know, but we expect it. So our entry is always in between the 618 and the 886. If we understand that we're in a retracement, guys, we let that move happen. And what we're looking for is exhaustion. And what I mean by exhaustion is I want to see
On Wix.
wicks towards the low. I want to see it form a higher low. I want to see it test some type of structure or some type of void that wasn't tested. That's what you want to see. And when you start to see that, that means, you know, hey, that's a nice signal or a nice opportunity for you to buy. Now, again, that doesn't guarantee that it's going to go in that direction 100% of the time, guys, but it's a high probability depending on what type of candle pattern you actually take over here. And that's why I say, yo, take those engulfing patterns over here because that's a high probability setup. So this system, like I said, guys, we break it all the way down to specific candle patterns that you want to take. All you got to do is just rewatch the videos and just learn it, write it down. Like I'm a print out or create a cheat sheet for you guys that, you know, lists all the steps, what you want to look for in each step and things like that. But again, you guys have to train yourself to look for it. But not only that, guys, like I said, once you understand that this is really it's not really a complex system, it's kind of simple, it'll click like that, and then the next challenge is honestly managing your emotions because you're going to get greedy. You're going to want to revenge trade because you know your shit now. You know what I'm saying? Like, and that's what happens.
And they'll kill you every time, sometimes too, though.
Oh yeah, sure will.
Can you zoom out to the 4 hour again? I want to see the zones that you marked up. I'm trying to.
I'll put it in perspective a little bit.
Yeah. So the first purple line. No, zoom out, please.
Oh, my bad.
That first purple line.
Right here.
That's the
Yeah.
That's the it broke. That's the resistance level, right?
Yeah. This is resistance right here.
Right. And then that's it broke structure, or that's the top of where that's the higher low, the highest low.
Where at? Right here.
Yeah, the second purple line.
Yeah, this is the structure. This is delineating structure that was broken right here.
Okay, because that's okay.
Because it's low. So this was a bearish trend, right? So
yeah,
in a bearish trend, guys, what you want to mark up is the lows. In an uptrend, you want to make sure you're marking up the highs because that's the structure that's going to be broken and retested.
Okay.
Repeat that one more time.
Yeah, that's a big nugget right there, guys. So in an uptrend, you want to make sure you mark off the highs because that's the structure that's going to be broken and retested. And once it's retested, that's going to create your higher low, and that's going to be delineating that you're still in an uptrend. In a downtrend, you want to mark off the lows because the lows are going to be the structure that's going to be broken and retested. And that's where our retest upon that break is where we enter for our continuation shorts.
So why is that purple line not on the top purple line, the first one, the highest one?
Yeah.
Why is it? Where is it breaking the structure? I'm not really seeing how it's. For some reason, I'm not seeing it. So that's
goes back to me understanding, you know, what a perfect or what a break of structure is, right? Remember me telling you that it takes one candle, the second should be a retest, and the third should continue. If let me highlight this area, and then we'll go on a lower time frame, and we'll see the structure right there. This just comes within hours upon hours of me just watching charts, guys. You'll get there. So if we look right here on the 1 hour, right? Break of structure, retest. And continue. This is just a retest. This would be a triple top because you got 1, 2, 3, right? So going back to what you asked earlier, Paul, right? Let's say this was the previous market. This is a great example. I'm glad you asked that because you got this hit, and now you got the consolidation, which made a higher low than this, right? But again, We are reading price action, guys. We want to read the price action of these candles because if we see this, right, that green candle, let me zoom in a little bit so that way you guys can see a little bit better. So we see this green candle right here, right? We're thinking, hey, that's a good buy opportunity. Cool. Now, this candle, cool. So on the lower time frame, if we just drew this line, you've got one candle that broke structure, kind of like a retest to it, right? Boom, but that third candle never broke the structure, guys, is what I'm getting at. This structure was never broke. Here's a retest to it, right? So here's your high, but these candles made a lower high than that. That's price action that you guys have to pay attention to when candles are at your support and resistance and in your zones. You just have to, and that's why I'm trying to teach you guys these different kind of patterns and candles and stuff like that. Because again,
So can you just read it based on those rejections that happen?
Yeah.
Because I would have entered right on that evening star pattern, the first one that formed.
Right here?
Yeah. And then just put
Short?
my stop above structure. Yeah.
Yeah, exactly. So let's look at this real quick. So we know that this is the most recent break of structure, and this is the inside return. So I'm fibbing from the high to the low. Okay, and it's in between the it's at a 50% retracement, basically, almost, right? So we see this evening star with this engulfing right here. Boom. We're automatically thinking that we're short. Now, you see this consolidation though would trick people. And then you see this right here, this engulfing would trick people. This is where, again, you have to be able to read the different type of candles. This is the Dragonfly Doji from the high, guys. That's letting you know, hey, boom, that's your high. After that, it never even got back up to the high. It wicked, but these candles made lower highs than that. And this is a double top, well, technically a triple over here, but your M formation basically, and it went down. Not only did it go down, notice where it hit our take profit, our first TP, right? And this is why I say, guys, just hold your trades to the take profits because it's going to hit it. Now, this whole trade probably took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 20, 21, 22, a whole day, right? This is where patient plays out. Being patient and sitting on your hands plays out. That's a swing trade. Not a position trade, but a swing trade or intraday trade, guys. Depending on what chart you called it on. Any other questions?
How
Yeah,
much time you got?
Yeah, we'll probably wrap up in a minute. I only want to try to keep these around 2 hours long because I know people try to rewatch this. 2 hours is about my maximum attention span, so I don't want to make you guys suffer. Yeah.
For your could you draw the Fibonacci again for your take profit again and your stop loss? I just wanted to see it again, please.
Yep. And I'll do one even better. This right here is the second take profit. This right here is the first.
So first TP and the other one is the second TP.
Yes, sir.
Okay, and then the 0 up top would be your stop loss.
Nope. This is my stop loss, the 1.1.
Okay, and that's your own primary stop loss.
Correct.
Okay. Hey, may I just see it one more time on the Fibonacci, please? Sorry.
No, you're cool.
Okay. I'm just zooming into it. And okay, I think that makes a little more sense.
Mm-hmm.
Okay, because you're in the middle, you're going here. Okay, I think I'm getting it now.
Ooh. It just takes a few moments, guys. But I promise, man, like I'm gonna spend enough time to where I'm gonna get you guys polished in this stuff.
And that first that Fibonacci that you took just now, that's the break of structure at the beginning, right? It's the first break of structure at the beginning of that move on the left above that box.
Right here.
This left.
Right
This where you dot for your fib tool.
Yeah.
That yellow line right below it, that's the break of structure right there for that red candle. Is that what that yellow line is?
Right here.
No, up top, right where the fib trail, the right there, or you drew your fib trail, your fib tool.
Yeah.
The yellow line right below it, is that to the left above that box? Is that where it broke structure? That way you're drawing into there.
Yeah, yeah. This fib I didn't really draw anywhere. I just drew it on here for him. But yeah,
Oh, okay.
this right here is a break of structure though, on that yellow line. Like you guys can back test that break of structure theory using the 3 bars, guys. It's pretty strong stuff. Like it's the break of structures. Like I said, minimum of 3 candles, 2 being in favor of the trend, 1 being a retest of some sort. Here's another one. Break a structure, retest, boom, 3rd candle. Rejection, right, of this structure. Here's a break of structure, but the 2nd candle came right back above it. Let's go back over here. No. Even though this was a doji, this is where price action and being precise comes in handy. It did indeed, if you went on the lower time frame, close above the structure, and this is the 2nd candle. The 3rd candle kind of was a retest, but again, notice that it has a little wick and closed still bullish in our favor to break a structure.
So if a doji closes above your line, it's considered valid, right? Or is that like an indecisive thing because you don't know how? Because the bears and the bulls are kind of not indecisive right now.
Right. It's still indecisive, and then you want to wait for that next candle to basically open and close. If you ever see a doji, guys, wait for the next candle after it to fully close, and that's going to let you know.
Okay. And if that candle closes up higher than that doji wick, then it's valid.
Correct.
Okay. What if it matches it? If it's like the same height as that, would you be like, I should probably wait for the 2nd candle after that?
Correct.
Make sure it closes above that, and then that would be like, okay, that's my validation.
Correct. That this example right here is perfect for that. So notice that this was a doji, right? It didn't necessarily close higher than this wick. This created a lower high than that, but this candle, they're all still closing. These 2 are definitely still closing above that structure line that we had right here. This candle definitely closed above all that, right? But then notice again, you've got 1 candle that broke this structure, 2nd candle that closed in our favor that tested it, a bearish candle that closed above that structure. That's another minor break of structure, right? And then it shot up out of there. Boom.
This might be a weird random question.
Uh-huh.
When on the charts, like the hour, 4 hour, 15-minute, is there a clock on TraderView where you can tell when it's going to close?
You know, I've never looked for it. I will say,
yes, there is.
Is there one?
Yeah, whenever that
at the bottom,
you know where the
right?
price bar, you know, at current market price or whatever, if you go to the right where the price shows on the right of the chart or whatever, it should say how long the candle got before it closes based on the chart that you're in.
Okay. Let's see.
Well, I mean, that's on the laptop. I don't know on the phone though.
Yeah. Well, it kind of does a little bit.
It's right there.
It's counting down,
it's
right
there. Look,
15,
it got 15 minutes left.
Yeah, 15:56, 55.
Oh, to the right there on the price bar.
Huh.
I never even paid attention to that. That's pretty cool.
Indeed.
Appreciate that, bro, because I really never paid attention to that. That's pretty crazy.
No.
I learned something tonight. Ain't that something?
Yeah.
That's dope.
Student becomes a teacher.
Yeah, man. I like that, though. Like, yo, like I'm never like too full of myself to learn some new shit, guys. Like, keep that in mind. Like, I'm always a student of the game. So.
That's what we like about you, bro.
I want to hear about what them zones that Ryan talking about.
Oh, those zones? Like, okay, so like I understand them a little bit. I'm not even going to try to explain it to you. I'll let them do it, but I understand them a little bit. They kind of align with like different Fibonacci levels and stuff like that. You'll just have to watch their training on that one, though. I'm sure they'll explain it more than I can, or better than I can. Any other question, guys?
Yeah, because I was asking C's about when he did before your class last time, he did a little zones thing,
Yeah,
and I was trying to figure if it tied into what you were saying,
it
or if
does.
you're just showing us something different.
It ties into as far as
The engulfing zone he was showing us
yeah.
to mark up. Yeah.
Mm-hmm. So it that would be like for like a precision entry. I would when you get into like the voids and stuff like that. And honestly, I may have them hop on one night once I get into like deep into like the entries, so that way we can go over it and tie it all together for you guys. Actually, it's pretty dope. It's pretty dope. So let me see. Next class, guys, goes over. Oh, what is today? Thursday. Yeah, so next class on Sunday is just like a quick review. I may even go over these slides again for you guys a second time because, like I said, they're filled with fucking nuggets, right? Like it's a lot of nuggets in what I went over tonight, guys, and it's gonna take you guys a second to understand a lot of this stuff. So I think I may go over this class again on Sunday just as like a review, and you may pick up on something that I went over that you missed the first time type of deal, right? So before we get off of here, let me check this chat to see. Yeah, this started at 7, Derek. Sorry about that.
Low key, I'm just trying to convince myself that I'm gonna have to take this class like 3 times.
So listen, you're not.
Yeah.
I mean, if you want to take the class 3 times, you're more than welcome to. Like I said, I'm still after this course is done. I'm gonna be spending some time with you guys, so you're more than welcome to. But
Yeah, bro. I'm probably gonna be doing this class like 4 times, bro. I'm right there with you.
Hey,
Are you gonna? I want to do some like markers myself. Is there like any kind of homework, I guess, per se, you tell us to be doing while we're like in between classes, or like what we can look for? Or...
Yeah, like I said, this is like the guinea pig course. I do have like some extra homework and stuff like that to give you guys. And then I plan on actually the next course is like once things like smooth and I figure out how long each class may or may not take. Like at the end of the class, I'm gonna give you guys opportunities to mark up some charts. You know what I'm saying? Like mark up your charts. So that way I can see what you're actually doing, what you may or may not need help with, and help train your eyes. Like, and the only way I'm gonna be able to do that is by seeing what you guys are seeing on the charts, by having you all mark it up. So, but that's probably the next course though.
That sounds good to me.
Oh, no doubt.
Yeah, me too.
I understand it. You guys need to practice it and then have somebody, watching you give you some advice right then and there. So that way you can kind of get that input and feedback, right?
Yeah.
100%.
That would definitely help. That would definitely help.
I already know, man.
Because some of these things make sense, but some of them, like this one I hear with the consolidation,
yeah,
I feel like I would just be like, nope. I'll wait for me to see something a little more clear, because that doesn't look very clear to me. Like when you explain it, yeah, but on my own when it's live,
yeah,
I would be like, yeah. So I'm just gonna let this ride out for a second and come back tomorrow.
that's highly recommended as a newer trader. So, but yeah, man, that's all I got for you guys tonight. Let me get this recording up and rendered, and I'll post it for you guys tonight, actually.
Yeah, that's what's
Always appreciate it.
Yeah, man, for sure.
Appreciate the knowledge, bro.
No problem, guys. I appreciate you all hanging out with me.